It's time for Yahoo Finance's Market Minute. Stocks are seesawing as investors assess the fallout from President Trump's fast-moving tariff policy. Meantime, big bank stocks turning higher along with the broader market, initially falling this morning amid mounting fears of an economic downturn. You can see, though, now moving to the upside. Morgan Stanley cutting its rating for the large and mid-cap banking sectors down to in line from attractive. The analyst saying the base case is for a significant GDP slowdown. We'll get earnings from America's biggest banks on Friday here. Crypto-related stocks, Robinhood Strategy, and Coinbase mixed as Bitcoin sells off along with the broader market. The cryptocurrency trading just above $76,000 today, well off highs from the post-election rally. And Spirit Airlines CEO Ted Christie is stepping down. Christie led Spirit through the COVID-19 pandemic, a failed merger, and a financial restructuring that brought the company out of Chapter 11 bankruptcy. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, investors are getting risk-averse and flocking to so-called safe haven assets. We'll break down what those assets are and give you a guide to investing in one of the most popular safe haven assets, gold. And a lot of people's 401k accounts have taken a massive hit during the recent sell-off. We'll get some tips from an expert on how to stay calm and optimize during a volatile market. Plus, all week on Wealth, we're talking about home buying as we head into the busy spring season. Today, we're bringing you the guide to getting financially prepared to buy a home. You don't want to miss it. We've got all that and much more coming up during today's show. But first, let's take a look at some of the market action this morning. 90 minutes into the trading day, and stocks, they have been fluctuating. Investors continuing to try and weigh the impact of the global trade war. Joining me now, we've got Sandra Cho, who is the Point Wealth Capital Management CEO and founder. You say the worst thing that investors can do right now is panic sell. Break that down for us.
Hi, this is Sandra. Nice to have you. Nice to see you again, Brad. So yeah, I mean, the worst thing you could possibly do would be to, sell during this panic time. You really want to see this as an opportunity, especially for long-term investors. So if you're in for the long term, dollar cost average into the market, buy the dips. And typically for long-term investors, it's a good entry point when the VIX is at 30 or above. The next 3, 6, 9, 12 months actually outperforms historically.
And so with all of that considered, where are the areas of the market and what is kind of like the decision tree that you're recommending people work through in order to best qualify what's a trade that they should be buying on the dip versus one that's down for very good reason that they should probably be staying away from until there's a little bit more clarity?
Sure. I mean, you want to stay with the common stocks that tend to outperform or the common sectors that tend to outperform during downturns. Stocks like, consumer staples, utilities, healthcare. We're looking at Costco, Walmart, Next Era Energy, Duke Energy. In the healthcare area, we're looking at Johnson & Johnson and United Health. And then, something that's kind of just a globally diversified bellwether is, ETFs such as DIV. So these are high dividend paying, globally diversified stock ETFs where, you can dollar cost average in and you're getting paid to wait, right? You are getting paid 6.61% in DIV and you could just, continue, wait. We've never been through a downturn that we haven't recovered from.
And so as you're thinking about some of those sectors and stock picks where you're identifying opportunity, what should people, especially in assessing what the fear gauge index, the VIX, can tell them about how much more volatility could be yet to come? How should they be assessing their portfolio up against that volatility amid some of the turmoil that's played out?
I mean, I would moderate expectations, our own expectations of, that this is going to be short term, right? I really our base case is that on the front end, a lot of countries are talking about retaliatory tariffs, but on the back end, they're likely having discussions and there are likely going to be some concessions. And then, then there, after that, there might be some kind of relief rally. But understand that these tariffs, are going to remain at elevated levels. So you really do want to expect that the volatility is going to continue, for the next, few weeks or months. Not all tariffs even have been announced, right? So there's potentially more tariffs to come. But that said, you really want to look at this as an opportunity because our investments are, long term. You don't want to be just in the market, which is known to be volatile anyway, over the short term, over just a few months.
And so just lastly, while we have you here, as we're thinking about the checklist of what to do if one of your investments is very clearly embroiled and caught up within some of the tariff talks, how do you work through that checklist and then aptly make decisions?
Sure. So, now is a good time to tax loss harvest. So if you've got gains, if you've got a position that, has still substantial gains in it, now's a time to maybe look at, selling some of that or even all of that and maybe buying something comparable so you don't have, you're not out of the market, right? And then that way you're able to, capture those gains, but, not have such a huge tax liability and still be in the market. Now, if it's lower, than where you bought it, maybe you even buy more of that sector so that you're not overly concentrated in that one particular stock.
Sandra, thanks so much for taking the time here with us. Good to see you.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Today, we're taking a look at an upgrade for Dollar General, delivery numbers from Mercedes-Benz, and some optimism for JetBlue. First up, Dollar General gets an upgrade from Citi, the analyst boosting the stock to neutral from sell and lifting its price target to $101 from $69. Citi saying Dollar General, along with its competitor Dollar Tree, are less at risk from tariffs than others in the retail space. Citi also noting that they should fare better as consumers slow their spending and those selling more discretionary items could be more impacted there. Next, Mercedes-Benz reporting a 7% fall in its first quarter sales compared to the year prior. The European automaker delivering just over 529,000 cars and vans between January and March. That's down from over 568,000 in 2024. The declines driven by slowing demand in Europe and China. While sales in the U.S. rose 1%, China was down 10%, Europe down 7%. And Raymond James upgrades JetBlue to buy. That's bucking the recent trend of downgrades on airline stocks. The analyst boosting JetBlue to outperform from market perform, saying the company is at low risk for bankruptcy and looks attractive amid recent negative sentiment. Coming up, gold hovering near all-time highs. What do you need to know about investing in the safe haven asset? We've got the answers next on Wealth. In times of uncertainty, safe haven assets can be a good source of security for you and your portfolio, and we're breaking down the basics. So let's start simple. What is a safe haven asset anyway when you hear about it? Well, it's an investment that's believed to hold on to or even gain value during periods of economic uncertainty. There are a few different types of safe havens, so let's break those down. First up, government bonds. U.S. bonds are considered a safe investment because they're backed by the U.S. government with a guaranteed return of your initial investment plus interest. They're also less prone to the same fluctuation as stocks or equities. Next, currencies that generally remain stable are considered havens. Some examples include the Swiss franc, the Japanese yen, and the U.S. dollar. However, the U.S. dollar status has been under pressure recently, concerns growing that if tariffs continue to move forward, that could slow U.S. economic growth. That said, many investors still expect the dollar's appeal to rise as global instability deepens. And finally, we must talk about gold. Unlike stocks or currencies, gold's value is not tied to any one government or economy, granting it stability. Central banks also hold gold reserves, which strengthens its status as well. You can see gold here down just a little bit today, but still holding above 3,000. And gold, it has been on a tear this year, roughly 15% in gains in 2025 as investors flock to the safe haven. With more volatility expected, though, in the near term, what's the best way to invest in bullion? Joining me now, we've got George Milling-Stanley, State Street Global Advisors Chief Gold Strategist. George, great to have you here in studio with us. Before we get into how to invest in gold, I just want to briefly touch on the assets record run this year. You and I have talked about this as well in the past. Is it too late from your calculus to buy into the safe haven?
Look, if I were a tactical investor looking for a quick short-term gain so that I can sell and make a profit, I'm not sure that this is the point where I would want to be getting in. It might work, I just don't know. But basically, I think gold really comes into its own as a long-term strategic allocation, rather similar to the stock market, that it performs best in the long run. And I think that when you're making a long-term strategic allocation, then the entry point really doesn't matter as much.
Certainly. And so there are a few ways for investors to put their money in gold. It could be ETFs, it could be physical gold, it could be minor companies. Perhaps let's start with ETFs. How is the best way for some of the ETF exposure that you've seen and the inflows that you've seen into ETFs that are tied to gold?
Yeah, look, I think it's important to remember that ETFs are physical gold, but the only difference between ETFs and actually owning bars and coins is that you don't have physical possession of the gold that backs gold ETFs. Somebody else looks after that. And that is actually an advantage for an awful lot of investors who see problems with, well, how do I custody this? Where do I keep it? Do I insure it? Do I bury it in the backyard, put it in a safe? What do I do with it? ETFs take all of those problems off the plate of the customer. What they give you is exposure to movements in the price of gold, and that's what most investors are actually looking for, rather than physically having gold in their hands and wondering how to look after it and where to keep it.
Okay, so those out there that are saying, okay, well, I've got my shovel in my hand, I was just about to go dig a hole so that I can put the gold in the backyard. What are some things investors should know and consider before buying physical gold?
Look, I think the problem with physical gold, buying bars and coins from your friendly local coin dealer, is that typically there's a fairly large markup over the value of the gold contained in the bars or coins when you buy, and frequently as much as 5%. And what the coin dealers don't always tell you when you buy from them is that when you come to sell, to take your profits or to take your losses, they're going to suffer a similar size haircut at the end. I don't like the equation that gold's got to go up 10% before I break even. The narrow trading costs that ETFs can give you and the relatively low expense ratios that gold ETFs can give you, to me, they're a no-brainer as far as gold investment's concerned.
So maybe you've had this question asked to you because as recently as a few years back, Costco started offering gold bars. And of course, it's not, a gold bar that is, like what we see in the movies. It's a smaller gold bar. It's got a design on it and everything. But what do you say to those who say, all right, well, this has offered me an entry point into an ounce of gold at this juncture? What is the strategy around that?
I think it's given gold a good deal of publicity. I don't know how much Costco is selling. I don't know, because I'm not a member of Costco, so I'm not even allowed to find out what the price is. I have no idea what markup they're charging, what premium they're charging. Are they charging the same kind of premium that a coin dealer might, like a 5% premium up front? I have no idea about any of that. What it's done is it's given gold a good deal of publicity, and I think it has been a starting point for a number of people who, the convenience of doing it at their grocery store makes a lot of sense to a lot of people. But I don't think it's ever going to replace investment in ETFs or investments in bars and coins for that matter.
You've been kind enough in the past and entertained my questions about gold price targets. Yep. At this point in time, what is your kind of best case scenario and base case scenario, or even worst case scenario for the price action and targets from here?
Okay, well, our worst case scenario is basically calling for gold to fall another $400 or $500. I don't believe that's going to happen. When we put together our price forecast, we only gave that a 10% probability weighting. We believe that gold is likely to stay in the area between 2,800 and 3,100. We're somewhere toward the top end of that area now. That's our base case, and we believe that if things continue to get better for gold, and with tariffs and the possibility of inflation because of the current administration's policies, and with all of the global turmoil, economic and geopolitical, we believe that gold could trade as high as $3,400 before the end of this year. I'm not saying that's going to happen next month, Brad, but I think that at some point this year we could see prices $200 or $300 higher from where we are right now.
George, great to see you. Great to have you in studio here.
Thank you, Brad. Good to see you too.
Coming up, should you be changing your 401k contributions amid the market sell-off? We're talking to an expert about how to avoid panic and set yourself up for success. That's next on Wealth. In some earlier market activity here that's been riddled with some, of course, rebuffing of headlines that ultimately shot the markets higher up and now has them in retracement off of the rebuffing of that news. Let's take a look at the NASDAQ composite and the major averages. The NASDAQ composite right now is down by about 1.5%. And we're essentially searching for clarity here. As we're continuing to see this fluctuation this morning, investors awaiting the April 9th implementation of significant tariffs on many U.S. trade partners here. And so all of those things considered, we're watching the Dow Jones Industrial Average here on the day. That did touch positive territory. And you can see the exact moves higher and across the board for the major averages and for some of the major players. Mag 7, toss a name out there, you likely saw the movement higher here. And it was interesting hearing some of the commentary at the end of our Catalysts Hour saying that that's how much pent-up demand there is for some of the investors out there to want to be able to have confidence to buy into any type of dip that we have seen continue to play out. We are essentially on a broader scale at the dip of the dippity dip, if you want to put it in some type of technical terms here, because ultimately there are a lot of retail investors out there over the course of the year to date, especially moving off of some of the highs, that have repeatedly been told to buy a dip or continue to buy in a dip here. Well, there's the dippity dip at the end of this. And so one of the major things, and this is going to play out more broadly in some of the sentiment, is, okay, how much further do you continue to buy in if you've already set positions here and now your average cost is going to be impacted to such a detrimental point if you do see some type of activity, especially for some of the major names here, as we're taking a look at the NASDAQ 100. This is the big banks. We'll come back to them in just a few days, and maybe I'll have a comment on that in a moment here. But taking a look at the NASDAQ 100, as long as our board will respond to me here. Okay, I'll just go back over to the major averages here. As we're taking a look at the NASDAQ composite, looking at the pullback here that we've seen year to date, and this most recent one, this is off of the tariff impact news. And one of the major things that you're going to be watching going forward from here is how executives are talking about the tariff impacts. Jamie Dimon, the CEO of JP Morgan Chase, the chair and CEO of JP Morgan, saying whether or not the menu of tariffs causes a recession remains in question, but he said in his annual shareholder letter, it will slow down growth. And that's one of the larger implications that a lot of investors are trying to get ahead of as well. Oh yeah, there's the added thought of what the Fed will do on the back of that too, especially given their data dependency and looking at lagging indicators, not forward-looking indicators essentially. And so all of that considered, we're seeing continuously some of the declines here, at least moving through some of the headlines that played out earlier this morning. The NASDAQ, the Dow Jones, and the S&P 500 are down. Let's see if this heat map responds to me just for a hot second here so I can show some of the sectors, and we will be able to show the sectors. 11 S&P 500 sectors, they're all in negative territory. The caboose right now is real estate, XLRE, that's down by about 3.4%. So as we've been continuing to track, markets continuing to fluctuate this morning as investors await the April 9th implementation of significant tariffs on many U.S. trade partners. And average investors may be wondering how this will impact their retirement portfolio, especially considering a record number of Americans are set to turn 65 in 2025. For advice on handling your retirement accounts, I want to bring in Dan Egan, who is the Betterment VP of Behavioral Finance and Investing. Dan, what should investors be doing right now?
For the most part, it's sticking to a plan that hopefully they have already set up. If you are continuing to save into your 401k, save on a regular basis. This is, as you said, a great chance to buy the dippity dip, great technical term there, often used within the industry. And I want to take a step back and do some historical context setting. So I have the joy of having lived through multiple financial crises, starting in 2001, 2002 tech stocks, 2008 the financial crisis, and of course the COVID pandemic. And in each cases, there was sort of an external reason that the markets went down, either deleveraging or a virus that took the world by storm, that we had to come up with a policy response for. We had to say, hey, there's something bad going on there. What are we as a society going to do about it? And we had to come up with that and agree to it. In this case, we know exactly what is going on. And if we want to, at any point in time, we can walk this back. This is a little bit less scary because we know what to do. And because of that, I'm a little bit more wary of any kind of especially partisan or political emotional headline whipsawing that might go on there. If Congress came out and said, hey, we're taking back power on tariffs, things could whipsaw right back faster than we've ever seen it before. So as opposed to other historical components here, there's greater possibility for things popping back very, very quickly based on one or two different announcements, as we've already seen today.
Certainly. And so is there anything you should definitely not be doing right now in this environment then?
Don't overconsume the news. It's good to check in every once in a while, think about how what's going on might affect your financial situation, but don't doom scroll. Don't sit there and keep adding stress to stress to stress, because you will get to some point where you break and say, I can't take it anymore. I'm too stressed. I'm going to make an impulsive decision. And one of the things you have to remember is that it's a two-way door, right? You have to decide to get out of the market, and then you have to decide to get back in at some point in a later time. And that's to your point about buying the dip. People are always saying it feels risky. When is it going to not feel risky? It's hard to get back in once you've gotten out.
And so for older investors, and we kind of acknowledged or alluded to this, older investors that are approaching retirement, is now the time to reallocate?
I wouldn't so much reallocate as one of the greatest powers investors have when they're around their retirement age is deciding exactly when to retire. There have been some great studies done on people who thought about retiring right before the market went down and decided to defer it just sometimes 6 months or 1 year, and how much better they ended off rather than trying to do it right when the market was going down. So the greatest power that retiree investors have is deciding when to do that. And once they retire, managing the first 2 or 3 years in terms of more about their expenditures, how much they kind of like set their lifestyle as, rather than reallocating. That said, I do want to be clear, as you are coming into retirement, it's generally good to have a much lower stock allocation, somewhere around 50% stocks, rather than the 70, 80, 90 that you would recommend for somebody who still has 10 plus years out.
That's good. And for younger investors, could a bear market be a buying opportunity? How should they be assessing that?
Definitely. Every case that you have a long time horizon, say 10 plus years, the market going down is more of an opportunity than it is something to worry about. That is the greatest advantage that we as individual investors have. Professional traders, they have to make money every year because that's effectively their salary. On the other hand, we have the power of patience. We can afford to last out the short-term downturns. So every time there is a buying opportunity like this, if you have some cash sitting on the side, it's not a bad time to use it. But also you should have just set up ongoing auto deposits into your 401k, such that you don't even have to make the hard decisions at these points in time.
You know, typically when we see downturns, that's when people start to become, or let me balance it out. When we see downturns in the equities market, severe ones, and then when we see some type of revolutionary move higher, that's when we see a lot of investors, retail investors typically, become a little bit more active with their ability to buy into a theme or head for the hills. And so in kind of both of those scenarios, how should people be making sure that they're both capitalizing on the opportunity for longer term trades when there are pullbacks like this, and knowing, especially in the uptrends on the other side of that, when they're being sold a stock that doesn't necessarily warrant some type of massive investment out the gate?
Well, one thing I would say is, don't try and pick the individual ones. That puts you into a double risk of both, like, what is the market as a whole going to do? And then how is this specific stock going to do? I love all stocks equally. I buy all of them, and they've all done well by me. The other component of it, I would say, is two things. Number one, try to just take as much as possible partisanship out of it. If you're getting excited because there's a dip, because you're like, oh, this is a great buying opportunity, I can't wait, or the opposite, markets don't care about your politics at all whatsoever, and stocks won't either. So try to take that aspect of it out to try and get a cooler head. The second is try to do something a little bit less extreme than you might be aiming for. So that might be trim 10% of your stock exposure off. Don't go from 100% stocks to 0% stocks. Do a smaller rotation of 100. You always have the option to make more adjustments later, but it's often the doing one big thing that you have to walk back, going from 0% to 100% and back again. That's the sort of move that's really hard for people to walk back or make fine-grained adjustments on. So do less than you're inclined to.
Dan, thanks so much for taking the time here with us today. Appreciate it. Coming up, the Home Buyer's Playbook. We're helping you navigate every step of the home buying process next on Wealth. President Trump is threatening an additional 50% tariff on China, writing in a post on Truth Social, quote, "If China does not withdraw its 34% increase above their already long-term trading abuses by tomorrow, April 8th, 2025, the United States will impose additional tariffs on China of 50%, effective April 9th. Trump also threatening to terminate all talks with the world's second largest economy if the tariff isn't removed. President Trump assuring that the public should have the knowledge of the negotiations with other countries will begin immediately. We saw stocks extend declines on the news here. Stocks have whipsawed today on mixed messages around tariff policy. An unconfirmed report that the White House is considering a 90-day pause on alternative tariffs, or all tariffs except China, sent stocks higher earlier in the session. The Trump administration quickly calling this fake news. Well, it's housing week on Wealth, and we have the Home Buyer's Playbook with everything that you need to know about every step of the home buying process, from the planning stages to the closing process to the first year of home ownership. And today, we're focusing on the first step here, getting prepared. Joining me now, we've got Melissa Cohn, who is the William Ravis Mortgage Regional Vice President. Great to have you back here with us. So let's start with the basics. What are the guidelines for qualifying for a mortgage?
Well, the first thing to figure out how much of your income a bank will allow you to use to qualify. For a conventional fixed rate, meaning something under $806,500, banks will allow you to go up to 50% of your monthly gross income to cover all of your indebtedness. So that would be the mortgage payment, real estate taxes, insurance, if there's an HOA fee, and any other debt that you would have, car loans, student loans, credit cards, other mortgages. If it's a jumbo loan, many lenders cap you at 43% of your monthly gross income. And if you're going to apply for a non-QM loan, meaning a bank statement loan or a profit and loss statement loan, there are lenders that will let you go as high as 55% of your monthly gross income to cover your debt.
And so, Melissa, how does qualifying for a mortgage work if you are self-employed, perhaps?
Well, people who are self-employed, oftentimes their tax returns are not necessarily reflective of what their actual income is. So we've had the advent of all these non-QM, meaning non-qualified mortgage lenders, that have come out and now offer you the ability to do a bank statement loan, for example, where we could take 12 months of your business bank statements if you're self-employed, and the bank will give you credit for a percentage of all of the deposits as your stated income. We could also do it with a profit and loss statement that would be prepared by your CPA for the prior 12 months, allowing you to show or use more of what your actual income is versus what your taxable income is.
And so how does this kind of come back to your credit score? How does your credit score impact the type of loan, the type of mortgage you're going to get approved for?
Well, first of all banks impose some sort of minimum credit score. With an FHA loan, probably the most aggressive, you can have a credit score as low as 580. But for a conventional loan, you figure you can go down to like 620 on a credit score. And for jumbo mortgages or an interest-only loan, many banks require that your score be over 700 or even higher. If you're looking at the non-QM lending, which is very popular these days, those banks will go as low as 620, but your credit score will determine what your rate is. The better the score, the better your rate. They'll determine the maximum loan to value. So if you have a low credit score, a bank's probably not going to let you go to 90% financing on a jumbo or a non-QM type loan. On a conventional, you can. And also, it's going to impact the rate that you're going to get. The higher your score, the better the rate. The lower your score, the worse the rate.
So how much financing can prospective home buyers get?
So if you're a first-time home buyer, Fannie and Freddie allow you to go up to 97% financing. There are even lenders that offer, like FHA has a 100% financing, where a bank will give you a 96.5% first mortgage and then lend you the extra 3.5% financing to get you all the way up to 100% financing with the FHA guidelines. If it's a regular conventional, as I said, 97% financing. If you're not a first-time home buyer, 95% financing. And if it's a jumbo loan or a non-QM type of loan, you're probably going to get capped at 90% financing.
And so for those who are still considering if owning a home is right for them, how do they kind of go about the calculus of making sure that, if they're renting right now, that makes more sense versus if they're owning a home and kind of going about that jousting, if you will, on the way to home ownership?
Well, it's always a lot about cash flow. Is it cheaper on a monthly basis for you to rent, remembering that your monthly rent payment is based on your net income and not your gross income? If you buy and you take a mortgage, your real estate taxes and your mortgage payment up to $750,000 worth of interest is tax deductible to you. So it's really a question of looking at the numbers, looking at how much of a home can you afford and how long do you think you would be in that home. And if you're looking for something that's very temporary, it may make more sense to rent. But if you think that you're going to make a move and it could be for a period of time, it may make more sense to buy. You get the tax deduction and hopefully real estate values will appreciate again, and then you would have all that built-in equity.
Melissa, always great to see you and get some time. Thanks so much for breaking this down with us.
Oh, my pleasure. Anytime.
You can scan the QR code on your screen to use Yahoo Finance's mortgage payment calculator, revealing your estimated monthly payment with principal and interest estimates built in. According to the Intercontinental Exchange's April 2025 Mortgage Monitor, the rate of home price increases slowed to 2.2%, with 95% of markets showing some improvement in affordability from the same time a year ago. Joining me now for more on the report and the state of the housing market, we've got Andy Walden, Intercontinental Exchange, Head of Mortgage and Housing Market Research. Andy, great to see you once again. What are your biggest takeaways from this report?
Yeah, I think it's not only slowing in overall home price growth, which we've seen over the last 3 months. You've started to see some divergence in the condo market that I think is really interesting. In fact, our enhanced home price index is showing condo prices marginally down from the same time last year. It's the first time that we've seen that since 2012. And so you're seeing slower overall home price growth in the vast majority of markets across the country, and a little bit of easing in condo prices as well.
So condo prices did fall in several markets. What do you make of that trend?
Yeah, I think there's a few different reasons for it. First of all, if you look at the slowing growth overall in the housing market, it has to do with rising inventory levels. You're seeing them almost universally across the country from the same time last year. When you look at condo prices, I think a couple things stand out. First of all, the condo market typically is a little bit more volatile than single family residences. And so when the market heats up, you see a little bit of overgrowth in that condo space. When the overall housing market starts to cool off, you see a little bit more softening among condos. And then you start to look at some of the multifamily completions that came to market last year, a little bit more vacancy on the apartment side, some more units being put into the market, leading to softer condo price dynamics out there as well.
And so investors right now seem to be pricing in 5 rate cuts over the course of 2025. So a lot of that depends upon what the Fed sees in the data, but do you think that we'll see significantly lower mortgage rates by the end of the year?
That's a good question. And we've already started to see them come down a little bit over the last few days. So if you look at loans flowing through ICE's origination channels, you look at traditional 30-year fixed rate mortgages, you've already seen that rate come down to about 6.5% on Friday. If you look at the ICE futures market, which is where we like to look to see kind of where futures for mortgage interest rates are being priced in, you look at that as of Friday, it was inferring that the market is anticipating mortgage rates to come down into the 6.25% range by September. And so already some modest improvements in mortgage rates that we've seen, with some potential at least being priced in the near-term horizon. So
do you think that the slower price growth and potentially lower rates will unstuck? I know it's not good English, but sometimes it's good preaching, as my pastor would say. Will that ultimately unlock some of the housing market?
Yeah, I mean, when you look at the buy side, right? potential home buyers out there in the market, you've seen them ebb and flow right along with interest rates. And so when interest rates have improved, affordability has improved, you've seen a little bit more demand out there in the market. We've already started to see the semblance of that this spring. In fact, when you look at February and March, you're seeing about a little over 5% more mortgage applications out there early this spring than what we were seeing at the same time last year. When you look at home sellers out there, you're also seeing not only more new construction in recent years than we've seen in the past, but when you look at existing homeowners and their willingness to put their home up for sale, you've seen some improvement there this year versus last year as well. So a year ago, we were seeing 25% deficit, 25% fewer existing homeowners listing their homes for sale. Early this year, it's been roughly a 15% deficit. So still not as many as you would traditionally see, but becoming unstuck a little bit, if you will.
Certainly. And what are some of the markets that you're starting to see elements of that take shape in?
Yeah, it's really the Sun Belt region of the country is the one that jumps out the most, right? It's where you're seeing more inventory come to market. It's where you're seeing that supply get back to or above pre-pandemic levels. It's also the area where you're seeing softer price dynamics. And in some cases, home prices come down from the same time last year. In the opposite end of that spectrum, the areas that are still dealing with very deep inventory deficits, the Northeast, the Midwest regions of the country, and unsurprisingly, that's where you're seeing firmer home prices.
Andy, good to speak with you once again. Thanks for taking the time.
You bet. Thanks for having me.
Coming up, everyone, employees are losing motivation. How can business leaders turn this around? We get tips from an expert next on Wealth. A brief programming note on today's episode of Financial Freestyle. Host Ross Mack speaks with Empify founder and CEO Ashley Fox about how she's revolutionizing financial education. Take a listen.
This is not the time to be scared. This is the time to go shopping. When you think about Black Friday, right? You have no problem when the entire store is on sale. Everything is red inside of the store. But when we see the stock market's red, we get scared. The way I look at it is the best time to go shopping is when the market is down. The best time to learn how to invest is when the market is down. This is not the time to be scared. This is the time to play offense. And when you really think about a lot of people who are brand new, we are afraid to invest in the stock market when it's up. Oh, it's too expensive. Now the prices are down. I'm afraid to invest because the prices are down. The timing of the market and what goes on in the economy does not have to dictate when you start building wealth.
You can watch the latest episodes of Financial Freestyle every Monday at 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Employee confidence hit an all-time low in February, according to Glassdoor's latest survey, as concerns over the health of the labor market weigh on sentiment. Declines in employee motivation are one of the main drivers behind what BetterUp is calling a performance crisis. The coaching platform calculates that human performance across industries has declined 2 to 6% since 2019, potentially costing $2.2 trillion in GDP. Joining me now on this, we've got Alexi Robichaud, who is the co-founder and CEO of BetterUp. Alexi, just break down what sort of performance declines you're seeing from your measurements.
Yeah, thanks, Brad. We're essentially asking workers how their performance has been over these periods, and we ask on very regular intervals, and we're able to track that longitudinally. And that allows us to triangulate with peer-reviewed journal articles of how these changes in sentiment about performance map to actual changes in GDP production, labor bureau statistics, and we're able to put all that data together and then extrapolate what would that be across the entire workforce in terms of a GDP decline. So what we find is, starting pre-COVID, really in 2017, but most pronounced starting in 2019, you see this decline in performance across almost every type of work. And we're tracking about 500,000 workers in this data set.
You know, as I think back to some of the readings that we've been getting over the past few months here, and thinking about JOLTS as well, because if we look at that longer trend line, the longer trend line since about 2022 has actually been moving in the downward direction in terms of job openings. So that means that more employees might be getting a sense that there are not as many reinforcements that are coming to perhaps help with some of those large tasks, essentially summing up to doing more with less. So how is that impacting the mindset and the performance? Because what we've also heard about is a burnout crisis here too.
That's right. Yeah, we track burnout as well, and that is approaching crisis levels. In our model, what we find when you look at the data is underneath almost every type of job performance, you can think of it as fuel in the tank. There's these three primary skills or mindsets that matter. It's a combination of motivation, optimism, and agency. And these feel really soft, but actually they robustly predict job performance and actually a lot of life outcome. And what we find is motivation accounts for 82% of that fuel, or what's in our tank as an employee, to your point. And motivation specifically has been in decline. And that speaks to our sense of feeling that our work matters. Do we feel we're being recognized for our efforts? Do we feel that we're being appreciated? When we don't feel what we do at work matters, when we feel like we have to do more with less, when we don't feel like we're getting a fair deal, our motivation dips and that performance fuel dips, and then that shows up in our actual performance. And so this is what both employees and employers are facing, is that with AI, with all the economic froth we're seeing, people are uncertain of their footing at work, they're uncertain of how their work contributes, and they certainly don't feel like they're getting fairly recognized for all their hard work.
And so what can leaders do to improve and boost employee retention and reverse some of these declines and boost what's at the core of this, which is motivation?
Yeah, I mean, there's a lot, but the most straightforward and the first thing we can do as leaders is actually the most cost effective, which is recognize our people. It's a very swirly time in the world today. People are working very hard. They're doing more with less, as you just said. And recognition is really free. Our communications to our team actually matters. This can be so simple. It's almost easy to skip over as a senior leader. But it starts with recognition. It starts with reinforcing why their work will continue to matter in the macroeconomic environment we see and in the world of Gen AI, having a clear perspective of that and communicating that we believe in their ability to harness AI and these disruptive technologies to continue to grow as individuals. So recognition and communication is the first. The second is actually investing in our people through growth opportunities. One of the most predictive things we find of both performance and loyalty to an organization is simply the degree to which an employee feels that there are personal growth opportunities. It's not rocket science, but again, it's easy to miss. So are we crafting as leaders, and the best companies we work with are doing this, clear roadmaps for people so they feel that they have a sense of forward progress, even if it's not a promotion, but they have a sense of growth and development in their career that intersects with everything happening outside of the company, what that means economically, what that means in the context vis-a-vis AI.
Alexi, great to have you here on the program with us. We'd love to continue the discussion at a future date as well with more of these insights. Appreciate it.
Thank you.
Let's do a final check of the markets here. It has been a wild one during today's trading session. Let's take a look at some of the activity that is playing out right now as we approach the lunchtime marker of the trading session. All major averages are lower. Fractional declines for the S&P and the NASDAQ. The Dow down 1.5%. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time.